Hello everyone, it's John Thynne speaking and Peter Haley. We're just talking today in relation to business valuations. We're both directors in the forensics section at Vincents. I can hear the City Hall bell, so we're 12 o'clock ready to start. Today what we want to do is give you an overview of the business valuation, process and arena in the current economic climate. And I say the current economic climate, I think we've been in quite a difficult climate now for probably 4 years, and I don't think that's really going to change in the short term. I'll just move forward. Now, the current economic climate, we're faced with a few things. Up until 2010, we really saw it in our valuations that we were doing. But the effect really started coming in probably about March 2008. We saw probably the effect of the GFC on certain clients, and from there progressively, depending on the industry the client was in, we started seeing the effect of the economy sort of taking hold. I think from 2010 to current, we've seen quite a fluctuation in the trading performance of individual business, but also the industry itself. The environment we're currently in, we've got reduced consumer spending. That's really been something we have been experiencing for the last 4 years, but it still seems to be continuing. We had a good Christmas, but it seems to have dropped off since then. The property environment, it's been depressed. We're looking at sort of things increasing. In some areas, the prices in different markets are improving. Others that are staying fairly flat. We've still got the issues with banks not lending in the area. We've got business in the construction industry is still depressed. Again, there's probably more hope than anything else that things are going to improve, but we're not really seeing a hell of a lot of it in the actual trading performance of businesses we're looking at. In fact, our insolvency department, which we're finding is a very good barometer of business performance. Although the growth of the division has slowed, it's still getting a high level of inflow of the unsecured creditors coming, or unsecured liquidations coming on board. And one of the primary drivers behind that is the tax office is still pushing a lot of people into that area. As I said before, the banks are now looking at things with open eyes. They're trying to finance, but we're finding that unless it's a really clean financing job, that we still actually have a lot of trouble with the banks actually closing the deal and getting it through their credit department. People still aren't generally putting the expenditure into repairs and maintenance and capital, the preventive maintenance programs and replacing equipment, which means there's going to be some significant outlays down the track. So the trading performance we're seeing now potentially is artificially high, or the cash flows particularly. They're inflated at the moment because they're not spending those amounts, but if we're actually looking at the future cash flows, which we are in any valuation, those things need to be considered. Economic outlook, we're at that stage where we're sort of looking at the economy improving, but with the current political environment, both state and federally, how's the effect of what's happening with both political environments going to affect our economy moving forward? We've still got, and this moving back to the insolvency side, we've still got a lot of customers defaulting, a lot of wind-up applications happening. Credit between, everyone's, there's a lot of businesses out there that are really starting to look at that credit side and tightening up their trade terms. And that last one we've got there is who's physically selling their business. Are we still in the environment that anyone who's selling their business is almost a forced sale, and anyone who's buying a business at the moment really is looking for a bargain? Is that actually affecting the ongoing amount that businesses are transacting for? All of these things still affect how we actually put our value in there. Now that value is very different to price, which we might talk about a little bit later. Now one of the things we said we'd talk about today is there more than one value? Well, the reality is there are a lot of different things out there that we actually get engaged to do. Most commonly, people get asked to, when they refer to value, most commonly people are talking about market value or fair market value. As you can see from that list, and that's by no means inclusive, there's a lot of different values we could be looking at there. That first one, after the fair market value being fair value, that's more a litigation type term, that the actual value that is determined can be adjusted to actually make the amount fair under certain circumstances. Again, true value, again, it's a litigation type term. The intrinsic value, what's the underlying real value? Replacement value. We've got to look at, is the actual entity being valued, or the going concern, or the the structure being valued, is it a going concern or actually is it not viable going forward, and therefore we actually look at a very different approach, which is leading into that liquidation or auction value. Book value, again, being a lot of accountants out there will know what that book value physically means. Special purpose value and value to party. If you're in the family law arena, the value to party or value to owner is a very important one. Special purpose value, someone may pay more or less than the actual face value for their own specific purposes. So again, there's a lot of different things out there that you can actually be engaged to do. You need to make sure you're being, your scope actually defines which value you're looking at. The definition of market value, and this is the generally accepted approach that comes through, and it first came, I think it was about 1907, I think it was Spencer's case, tax case, that came through with this definition. The price that is negotiated in an open and unrestricted market between a knowledgeable, willing but not anxious buyer and seller acting at arm's length. Now technically, if you don't have one of those factors satisfied, you don't have market value. So it's very important to make sure each of those are satisfied.
Yeah, it's interesting. Arguably something like a pharmacy can never have a market value because it's a restricted market in that only pharmacists can buy it. So, I mean, that's sort of changed a bit over the years as people have found their way around it. But generally, when we do valuations of pharmacies, we still treat it as a market value because there is still quite a wide and openly traded market for those out there. But strictly speaking, you could argue that it possibly isn't a market value.
And also, if you've got a seller who needs to sell, they're an anxious person. If they've got someone actually looking to buy but they're not prepared to pay market, they're looking at a bargain, or they're being forced, they need to buy, maybe for some sort of visa reason, they need to actually buy the business for their own purpose. They may be an anxious buyer. And again, if you've got related parties, are they trading at arm's length? Now the second way of looking at market value is to say the amount that a prudent investor is prepared to pay in order to receive the future expected earnings given the level of risk. So essentially we're basically saying what are the future cash flows associated with this business given the actual risk associated with that business. And those two major factors are the cornerstones to any business valuation. You are looking forward, you're not looking back. So it's very important when you look at a valuation, it's not just a matter of looking at the last 3 years, doing your adjustments and averaging of 3 years. It may be correct, but what you're really trying to say is we look at the past as a proxy for the future, but we must consider all factors that we know about the future. And the maintainable earnings or the cash flows you're adopting need to reflect that. And then it's coming into the actual level of risk. What is the actual risk associated with those cash flows? And those two cornerstones are important in absolutely every valuation.
So the general rule is, if you can quantify the effect of any known factor, you should be adjusting those future cash flows. If you're aware of a possible factor, but you can't quantify it, well then that would probably be taken account of within the discount rate.
Another one of the points we put out there is should the value last week be the value next week? An important thing to understand with business valuations is the price, or the value actually determined does not fluctuate a great deal from day to day. Now that's different to something like the stock exchange where you'll see that the actual price one day, something happens in Spain or Greece or there's, heavens Betsy, a plane crash, it can affect the actual values on our stock market. But if we actually look at the definition above where we start looking at the future earnings given the risk, unless the actual cash flows, expected future cash flows are going to change, the level of risk could change, or later on we'll show you how this factors in, or the infrastructure of the business changes, the value of the business should not change. So really for a change in the business value, you need to have a change in cash flows, risk, or the infrastructure being adopted.
And a reasonably major change, I would have thought,
We quite often get asked to update our valuations for family law purposes. It might be 6 months after we've done the initial valuation, or we get asked to actually critique someone's valuation that's been updated. And what we often find, particularly in the critiques we're looking at, is that the actual value has changed dramatically in that time. And the reason is that the application of the methodologies hasn't been done correctly. And that's why the value's changed, as opposed to something's fundamentally changed in the performance of the business.
But having said that, I think certainly in the last few years, more so than going back 5, 10 years ago, we are seeing values change. From 12 months ago compared to whereas 5 years ago there weren't too many businesses. If you had to do an update of a valuation, that you noticed significant change. Whereas there are those, as John was saying, you can get changes, major changes in a business if a business value, if you have a major change in your cash flows or the risks, and those sort of short-term major changes are happening more so now, more than what they were 5, 10 years ago.
And that may be something simple but quite fundamental, like we've won or lost contracts in the business moving forward. The definition of goodwill, there's a high understanding out there in the public that goodwill relates to reputation, sales, product, all of those types of, I guess, factors or characteristics of business. Goodwill, commercial goodwill, is all about profits. It's all about an expected return over a return that covers the actual cost of our infrastructure being used. Unless you have profits into the future, over and above this benchmark amount, which we'll show you shortly, you won't have goodwill. Now the easiest way to describe that, or explain that, is if we look at a business that's amazing reputation, sales of $20 million on a product that's amazingly popular, we've been in the same location 20 years, really strong clients, they all love us, but we're making a loss on our product. Is someone going to pay a premium over and above the actual infrastructure to make a loss? So it just comes back to goodwill's all about profits over and above benchmark return.
I mean, that might be why they've got such great sales. They're selling cheaper than anyone else for the an equal quality product, and that's why their customers love them. But at the end of the day, if you're not making money, you're not going to have any goodwill. Okay, so now we get on to methodologies, and probably the starting point is normally going back to that second definition of market value, where we look at the risk and return. So looking at the return is normally based on the earnings, and we've got capitalisation of future maintainable earnings, which I think you'll find out there in small, medium SME world is the most commonly used methodology, although interestingly, if you pick up any textbook, discounted cash flow is normally the one they talk about. The capitalisation of future maintainable earnings methodology, which I'll go through in a sec, is just a short form version of the discounted cash flow. The third one there, the capitalisation of dividend payout, that's normally used where you've got someone who's got a minority interest in an entity. So minority is normally 20% or less. So they've got no say in the management, or very little, no say in how the thing's being run, what the future direction is. There's probably also issues in terms of being able to get out, because obviously you can't force a sale, depending on if there's a shareholders agreement that might have some sort of avenue in there or whatever. But ordinarily, it's harder to sell a 15% interest in a closely held business than it is selling 100% on the open market, where someone buying it will have complete control. So in that case, the earnings you get out of this thing in the future will only be what the dividends it's paying to you. So it's only worth to a potential purchaser what those dividends are. So
that's then on the actual stock market, where you see what's the price-earnings ratio associated with that business.
And super profits is something that you sometimes use to value professional practices, where you're really saying, well, if I buy this practice, essentially, it's still a reasonably small operation, but what I could be making $100,000 as an employee somewhere. If I buy this practice, I'll be making $180,000 a year, so I'm really going to increase my personal earnings by $80,000 a year. That's my super profit, and what's that worth? And then the asset-based methodologies is really just, if you're looking at an entity, a company, trust, partnership, whatever, what is the net realisable value of the assets, less liabilities? So, and there's sometimes a dual methodology whereby one of those assets is the business, and that would incorporate the goodwill.
And under this methodology, it's important to actually, again, determine whether you're actually doing this on a going concern basis, or whether you're doing it on some form of liquidation, fire sale, or forced wind-up basis. if you're looking at something like plant equipment, or take fit out of a building, it may cost you $100,000 to fit out the office. As a going concern, it's worth $100,000. But if you're winding up that business, what's that fit out worth?
Probably about $1,000, is what you get at the auction for it. And even things like stock, if this is a loss-making enterprise and it hasn't got a great future, and the conclusion is it's not a going concern, will you be able to even get your cost for stock, or are you going to shut down in 3 weeks' time and just hold a fire sale for a week and just get whatever you can for it? So you really need to look at each individual asset and liability and consider, that the value you adopt can vary substantially whether you consider it's going to be realised as a going concern or not. So then you have some other methodologies there, and rules of thumb, they're quite common down in the smaller end of the market. So things like real estate rent rolls, which are valued on a multiple of the actual gross commission, and that's what you'll find with these rules of thumb. They're just about always a multiple of the gross revenue. So it's not, profit doesn't come into it at all. So things like, as I said, real estate rent rolls, financial planning practices were, but they're moving away from it, a multiple of the recurring commissions that you get on your clients' investments. Even things like 7-Eleven stores and IGA supermarkets, they sell on multiples of weekly sales. So again, it's the gross sales, it's not the profit. And what you'll find just about every time you do a rule of thumb valuation, the value will be substantially more than what you'd do if you employed one of those earnings-based methodologies or asset-based methodologies. So when we do a fair bit of work for the banks, financing things such as 7-Elevens and IGAs, they really only want to know what it's worth, certainly for an IGA, based on an earnings-based methodology. They're not interested in the rule of thumb, although interestingly I just did a 7-Eleven yesterday and they did want to know what the rule of thumb was, so just to confuse things. But and that's probably because down in that end of the market you're only talking businesses that are possibly worth a couple of $100,000. If worst comes to worst, 7-Eleven's got a reasonably good name. I think the bank is reasonably happy that the business could be on-sold. And lastly on that slide we've got market-based transactions. So typically if you're valuing real estate you try and find comparable sales. The difficulty of valuing a business is there is no generally accepted database of comparable sales. I mean, we've got our own internal database to some extent of some of those things we do a lot of, which are those bank type ones, pharmacies, supermarkets, 7-Elevens, some other franchises, things like that. But move away from that and it's very hard to get any sort of reliable database. The couple I have heard about and investigated, it's questionable as to what how reliable the data is. They might say, oh, that business sold on 3 times earnings, and you don't know whether when they're saying earnings, is that earnings before interest and tax or after interest and tax or before an owner's salary. There's no detail in a lot of the stuff that's out there that some of the business brokers put out there as being a database of transactions.
You don't know the spread of customers, you don't know the actual skill of the employees, the skill of the owners. There's a whole range of factors there. To actually have a comparable business, you must literally have the same business out there. And that's the problem with market-based transaction. It's also one of the big problems with a lot of the side. We see a lot of comparisons of businesses to publicly listed companies, which the comparison, on a lot of cases, the majority of cases, in the SME type market is flawed in that we don't have all of those factors you have in a company that has a market capitalisation of a couple of $1 billion compared to a business that turns over $20 million. They're not comparable, and that needs to be taken into account.
And in some ways, some of those medium enterprises, the liquidity of them is actually worse than the smaller ones. It's more difficult to find someone as buyer of a business you're trying to sell for $5 million than one you're trying to sell for $250,000. There's just not as many people out there. So, yeah, but again, there just isn't a database there that tells you that anyway. Okay, so just go through the capitalisation of future maintainable earnings methodology in a little bit more detail, which probably most of you are quite familiar with. So step one is you've got to determine the future maintainable earnings. So as I said, it's an earnings-based methodology. And as John said earlier, you know, it's not a simple matter of just, oh, what's the last 3 years, divide by 3, and you know, multiply by some sort of factor. That's fine if the last 3 years you're expecting to do something like that in the next 3, 5, 10 years. Because that's the other thing you've got to remember. This is, theoretically at least, a valuation of an income stream into perpetuity. Now, in reality, it's probably, you know, you're thinking it's going to be at least a 5 to 10 year sort of thing. So, what are your expected earnings? So you know, have a look at the historicals, yes, but then you've got to say, has anything changed from that to what's going to happen in the future or expected to? So after you determine the earnings...
Sorry, Peter, can I just say with that one, we quite often see businesses valued, but they don't use the last 3 years. They basically say, look, this business has a business cycle. So we'll actually use an average of the earnings over the business cycle, and it may be sort of 5 years or 7 years. The problem with that is you can only use that business cycle if nothing else in the business has changed, such as infrastructure. And I don't know if I've ever seen a business that for 7 years has kept the same level of infrastructure. It's either grown or contracted, and that can be employees, the actual how they operate, where they operate, the actual type of equipment they've got, the terms they're offering to client, or even the actual the market they're physically operating in. So the problem is you must use what you believe is going to go into the future, taking everything into account. It's not just appropriate to make broad assumptions like average it over a business cycle.
So sorry, I should just say, you know, the most common, when you're determining future maintainable earnings, you normally start with the profit and loss account and then adjust that for things such as, you know, what is a true salary for the owner. So when you're doing the earnings, you're saying, as the shareholder or investor, if I employed everyone on an arm's length basis, sure, I might work in there, but I need to get a return on my labour commensurate with my skills and hours worked, etc. So for tax reasons or whatever, you mightn't draw very much, the current owner may not draw a very big salary out of the business at all. But as the potential investor in that business, you need to say, well, I really need to pay someone, you know, 120 grand a year to run this thing. So you need to factor in to the reported profits what is an appropriate level of salary. And similarly, you know, there might be no rent paid because the entity that runs the business also owns the property. Well, that's a separate investment decision again, is the property as an investment versus the business as an investment. So you need to factor in that the business needs to be paying rent to work out a true profitability figure. Okay, so once we've determined the future maintainable earnings, we've got to determine the capitalisation rate, which is really a factor to take into account the risks involved in this business. And typically, you'll find the capitalisation rate in most small, medium businesses will be somewhere in the range of 25% to 35%. And you're saying that's the risk attaching. They're often referred to as multiples, a multiple 3 times. So the perception out there is that the value is saying this business is worth 3 years' profit. Well, yes, that's the answer, but what you're really saying is for the risks attached to this business, I think an investor needs a return of 33%. And the way the algebra works in the calculation, that equates to a multiple of 3 times. But it's not just as simple as saying it's 3 years' earnings. It's really a risk rate expressed as percentage, but then inverted to a multiple.
A couple of things there. You also need to be very careful that you're actually comparing like with like. So you need to actually work out, are your earnings on a before or after tax basis, before or after interest basis, before or after depreciation basis. So we're doing EBITDA or EBIT or NPAT. We also, we quite often get asked, how do you physically come up with that capitalisation rate? Because the one subjective amount that's there, it's the one sort of unknown. The reality is there are a couple of approaches in theory that you can apply. You could do a build-up method, where you start with a long-term government bond rate of, say, an average of 5%. You start adding a premium for equity. You start saying, well, that's before tax, we need to go after tax, we're not publicly listed, therefore we don't have the liquidity, we're a small business, we're one location, one product. You start adding in risk factors. You start taking away things like, we've just won a great contract, we can get a lot of growth in the future, you might take a slight reduction in the capitalisation rate, the amount. Keeping in mind that the higher the capitalisation rate, the lower the value is going to be. So you've got the build-up method. The problem with the build-up method is each one of those amounts is subjective. Do we add a 2 or a 10% premium for the fact that we're a small company? That's the major flaw, but as a test check, it's very helpful. Another way, which is probably the more theoretical way to do it, is actually do the financial maths behind it. So firstly, you'd actually look at what's the actual physical cost of equity, so you'd actually apply the capital asset pricing model. And then you'd actually say, all right, well, we need to actually say that we're doing our cash flows on an EBIT basis, therefore we need to, discount rate needs to be a WACC, weighted average cost of capital approach, to look at the actual cost of equity and try to actually work out the optimum level of debt and equity in this type of business. Ultimately, the problem with that is, again, you're coming up to very subjective amounts, and one of the factors you come up with is, how does this business compare to the publicly listed arena? And if you're looking at something like, say, the fish and chip shop on the corner compared to how BHP is trading, I don't know if they're overly comparable. So from that point of view, ultimately, in the SME type market, which is largely where we deal in the in Queensland, ultimately it's coming back to a subjective assessment based on experience, and using the other methods as a test check.
So then you, after you determine the earnings and the capitalisation rate, you divide the capitalisation rate into the earnings, and that comes up with your business value. So important to remember that number you come up with then is the total business value, which includes all the business assets and liabilities. So take a simplistic business that only has stock. That's its only tangible asset that needs to run this thing. You buy all your, you don't have debtors or creditors. You just purely, you buy all your stock with cash, and all your customers pay cash for you, so you've only got stock. So if you assume that earnings are $100,000 a year, you've concluded the capitalisation rate is 25%. 100,000 divided by 25% gives you a business value of $400,000. If you had $300,000 worth of stock needed to run that business, some people think the $400,000 is the goodwill, and you add the stock on and say the total value is $700,000. If that's the case, you still only make a $100,000 profit, but your total investment, if you bought the business on that basis, would be $700,000, which means you're really only getting your $100,000 return. There's only about a 13% return, not the 25% that you've concluded that you need to get. So that's probably the biggest mistake we see in some valuations done out there, is that people don't appreciate that earnings divided by cap rate is the total value, including all the business assets and liabilities. So as I said, yeah, if the capitalised earnings is greater than the assets, you've got some goodwill. If it's less, then the theoretical investor would say, well, if I've got stock of $300,000 and I'm only making $20,000 a year profit, I'm better off just selling the stock, going away and putting my money into an investment that is giving me an appropriate rate of return.
Now that reference there to goodwill, that's probably a simplistic analysis of what it is. The difference between your capitalised amount and your net tangible assets is your intellectual or intangible assets. Your intangible assets includes your intellectual property, your IP, so it may be a computer program, software, a patent, some sort of trademark, and the value of goodwill. So it's the whole lot. Now in most SME type businesses, they don't have intellectual property. It comes down to being goodwill. But it is something to consider. It may be that the intellectual property is actually a client base.
Okay, so there's just an example. So that's, I think we'll just run through this quickly. That's what I was saying. So in that example there, if you have 100,000, 33% cap rate, end up with $100,000 worth of goodwill, or as John said, intangible assets. If your profit was only $50,000, still the same risk factors, so 33%, capitalised value of $150 is less than our net tangible business assets, we don't have goodwill.
And although that's a simplistic example, a lot of them literally come down to this type of approach. But by looking at that, you can see that every one of those factors has a significant influence on what's physically happening here. So, for example, the maintainable earnings, coming up with maintainable earnings, by dropping at 100,000, that could be for the commercial, commercial worth of the owners, could be rent, it could be the contract, what average we're using, whatever it might be, has a significant effect on the answer. Once you're in goodwill territory, which is this first example, for every dollar you change your future maintainable earnings, your profit, we're changing the answer by $3. So it's very subjective and very sensitive. Capitalisation rate, whether you're using 30 or 35, the reality is it's never one amount. It's always going to be within a range depending on the factors you take into account. And again, the net tangible business assets, it's not the balance as at a certain date, it's the average infrastructure you need in that business. And that will fluctuate. Your assessment of that, the actual physical dollars will change from year end to year end or particularly throughout the year. An example may be if you look at the level of stock levels in early December for a retail business, they're going to be quite high. And if the business is running well, in January, those stock levels are going to be quite low, but hopefully their cash is high. So what's the average amount needed in that business? It changes depending on where you are in the cycle. And when you're doing this analysis, we need to work out what the average infrastructure is required. What's the average balances?
And just say on that second one there that's on the screen now, it's still a profitable business. It's just not getting the return that, as the valuer, you are saying you need for the risks associated with that business. That's all. It's not on its last legs. It's, it's still a going concern, still profitable, but a $50,000 profit on $200,000 worth of assets, it's only a 25% return. That's not good enough for the risks involved. That's really what you're saying.
Now, a couple of examples. This first example, we've got a business involved in the construction industry. This is a valuation a couple of years ago. Business involved in the construction industry, Southeast Queensland, but also has primarily Southeast Queensland, but also has a presence in Northern Territory, New South Wales and Western Australia. We've got 2008-2011. We've got turnover going from essentially $12 million down to 5, then back up to 7. Profit from 2.7 down to 100, up to 830. So that's what you've seen in the profit and loss statements. We do our normalisation adjustments for whatever they might be. There may be commercial salary, it could be a few other things. And we come up with an adjusted profit of 2.5 down to a loss up to $650. That's $650,000. When we've done our analysis there, we've come up with our maintainable earnings. So we're doing this as of 30 June 2011, so we're looking forward, and we can see our adjusted profit of $650,000. We've got maintainable earnings we've adopted there of $650,000. Now, if we'd taken an average of the past, where would our profit been? And that's the important thing here to remember, that a business valuation is all about the future. The past is our reference point. We analyse and understand how the business is trading, but to actually work out what the maintainable earnings is, you've really got to actually go and look at what's the future holding. So this is a construction business, so with any sort of large construction business, you'd expect it's going to have a high level of contracts. There'll be tenders, there'll be contracts, things that have been won and things they're actually hoping to win. In determining the maintainable earnings, that's exactly where we go. What's it actually going to do in the future? Well, in something like construction industry, it's quite easy because you actually dive in and have a look. What have they actually physically won going forward? Capitalisation rate of 27.5. I can't remember the specifics of this one, but there'll be a lot of factors go into it, including how secure is the contracts going forward. Are we looking at growth? Are we looking at the business contracting? What's the market? What's the economy? Are we looking for an expansionary type outlook, or is it going to start contracting? So we came up with a capitalised value of 2.4 million, net tangible assets of 1.83, giving us goodwill of 530. So that's a business that a year ago was making a loss, so we still came up with goodwill, and that's based again on the future. Now, a reasonableness check here is to go, all right, would someone physically pay $530,000 for this business? As a test, let's start looking at the pre-tax payback. So goodwill of $530,000, what does that represent of your maintainable earnings? How long will it take out of pre-tax dollars to repay that amount? is there a risk that those earnings won't stack up and won't actually be around long enough to actually pay that amount back? They're the types of the rationale you go and think about it. Now, an interesting one here, what effect if valued at 30 June 2009? So if we actually go back to look at the example, in 2009, or even particularly 2008, what would have been the value? So if we'd actually done the history, just valued it on the history, in 2008 it made 2.5 million. Now if we multiplied that by 3.5 times, we're going to get an astronomical value on a business that's contracting. And the same with 2009, if we'd valued it just using the 2009 results, or even average 2008 and 2009, moving forward it made a loss. Now you could have actually looked at that, looking at the contracts at the time, and determined that they're actually contracting. You could also just open your eyes and look at the turnover. But there's sort of things you need to take into account. The next quick example, an electrical business with a primary focus on overhead and underground power installation and maintenance based in North Queensland. Now this business here, the actual downturn's a little bit deferred. With 2008 at 3.6, then 6.4, 6.6, so it's expanding. And 2011, we're valuing it as at 30 June 2011, you can see it's contracting. Pre-tax profit increased a little bit, but then actually starts to drop. And interesting, in 2010, the actual profit's dropping despite the increase in turnover. And what the analysis at that point showed us, that they're actually dropping their margins on their tenders to win work, given the actual contraction in the environment. Put through our adjustments, we come up with an adjusted profit, 250, 540, 90, 210. So this is clearly a business that is hurting. 2009 it's been sliding. 2011 it's made a loss. And again, the big things here is to actually going, what's going to do into the future? What information can we attain to actually look at this into the future? And again, this one here is the sort of apart from looking at the economic cycles, we are looking very much at the specifics of this business, looking at the tenders and the contracts and the profit margins with those contracts. In this case here, we actually it didn't turn around. We actually have negative maintainable earnings, which puts the goodwill at 0. Net tangible assets was 560,000. And in this case here, given where the business was making some rationalisations, so although the maintainable earnings was looking negative, or at best break even, moving forward it was still actually looking like it was going to improve. So from that point of view, we still valued this on a going concern basis, and net assets we took largely on a going concern type basis. But again, if we looked at valuing this at 2009, we have a business that actually has been growing, 250, 540. Would the actual answer been different in 2009? Peter.
Okay, so we've got there the three primary drivers of valuation, which hopefully were illustrated in those examples there. So firstly, the profitability, next the risk, and the working capital, the net tangible business assets. So profitability, as we keep saying, it's all about the future, not the past. Allow for known events. You can use the past if you consider it is a valid proxy of the future. Next one's quite an interesting one. Only include the core business items. So if you're looking at the profit and loss statement, just make sure, if you're valuing the business and this entity, the trust or company also does some other things, you've got to make sure you strip out those other things and only include the actual business income and expenses. Exclude the non-recurring items. So for example, why that first construction example was excluded and why the turnover was so huge in that first year, they'd done a whole lot of work, I think, from memory, following Cyclone Larry and rebuilding a couple of resorts where they were able to, because they wanted to get those resorts up and running again, the operators, ASAP, and they could almost write their own check in terms of, so they got great margins on great amounts of turnover in a very short time. But you would think, that's not something you'd expect to happen every year, although one of those resorts, I think, was then, it was actually destroyed again about 2 years later by another cyclone. But it's not something you'd expect to happen as every year. Obviously, resort owners aren't going to rebuild their resorts every year. There'll come a point, as they did it the second time. I don't think they rebuilt it that time. They're sitting on their heels a bit now. And the last thing there is after commercials owner salary, which is what I mentioned earlier, that you've got to factor in that the owner, if the owner works in the business, they're entitled to a return on their labour you're valuing the business, which is a separate thing again.
That last one can actually be quite a material issue. If we were doing something like valuing an accountancy or a law practice, you need to put a commercial salary in there for the principal. So if we look at an accountancy firm, we go to Hayes salary surveys. For a small to medium type firm, they sort of start out at about sort of $130,000 salary plus superannuation. For a smaller firm, and it starts increasing from there. But if you're looking at a business that may have, let's say, 4 owners, if you use 100 with superannuation, 140 odd, or $145,000 salary as opposed to 180 or 200, multiply that by 4, you potentially have a $160,000 swing, give or take, by a multiplication of, say, 3 or 4 times, depending on the type of practice it is. Suddenly you've got a mammoth difference in the outcome, and that's largely going to be potentially goodwill. So coming up with what's a reasonable commercial salary is very important.
So how we normally determine that is you normally talk to the owner and first of all just say, well, what are you paying your number 2? So that's your base. You've got to, presumably the owner's better than number 2, so it's got to be more than that. As John said, try and find some salary surveys. So there's salary surveys out there for just about everything. And if there's not, we've got a consultant we use who will provide us with a short film report as to what, because that is another area of expertise, is what is an appropriate owner's salary. So if it's something reasonably straightforward, you can normally get it either through experience or just salary survey type things like Hayes for accountancy practices. If worse comes to worse, you may need to engage a specialist remuneration consultant who can tell you what someone with that position, skills and hours is worth.
That's interesting. You talk to pretty much any owner of a business in a matrimonial, they're going through and they'll say as soon as they actually work out the effect it has on the valuation, they're suddenly worth $500,000. They wouldn't move for for under $500,000.
Interestingly, most of them tend to talk down their salary, thinking that will help their case. But when they work out the effect it has in the valuation and how the methodology works, then they start talking it up.
The other thing I was going to say here, and it really comes into the methodology you're choosing, is what do you do when you've actually got, like the examples we had before, what do you do when you've actually got a high fluctuation in the actual turnover and profitability of the business? What do you do if it's actually a business that historically is traded at a loss and we're predicting in the future it'll trade at a profit? What maintainable earnings do you physically adopt? What do you do if you actually have a business that's got a high growth, but obviously that won't continue into the future? It'll start plateauing out. How do you actually physically factor that into the actual methodology? Probably 95% of what we look at comes in on the earnings-based methodologies, comes into the capitalisation of earnings, or multiple of profits. But how do you come up with one profit figure when that physically happens? And that's where the discounted cash flow approach, in theory, is always more correct. However, in practice, it's very hard to apply. Sometimes you just don't have a choice. Other times, it's important to actually do it as the discounted cash flow as a test check on your actual result to see if it actually is correct.
But the capitalisation of future maintainable earnings methodology is essentially assuming that level of profits is constant, for the next, into the foreseeable future. If you do a discounted cash flow and you look at each individual year separately, you can factor in if you're expecting, reasonably major fluctuations. So primary driver number 2 is risk. So what you're trying to account for here is, the risk opportunities, and the other thing there, importantly, is growth. So it's not all about risk; it's also about, potential upside. The industry. So if you know the industry is something that's in decline, you'd expect that your business to also, follow along, tag along with that, and vice versa if it's in a growth sort of thing.
The important thing there also is actually looking at, there's a couple of analysis type theorems out there, the Porter theorem and the Perk theorem and the like, which really what they're saying is you need to look at all the sort of the primary factors associated with that business, looking at the customers, looking at the suppliers, looking at competitors, looking at the actual physical product. And that's where it's looking at that physical product there. We're not experts usually in the areas we're valuing, but if you're looking at something like some sort of computer software and they're doing extremely well, will that continue into the future? You look at something like MYOB. MYOB's done extraordinarily well in the past. How's it going to go into the future with competitors like Xero and the like coming in? those types of issues we need to actually physically address in the valuation. And if you're not able to physically address it yourself, potentially get the expertise to actually advise in that area.
Third factor there, the type and diversification of work. So, you know, again, if you've got a spread of work and a spread of type, I did an engineering firm recently that basically they were experts on road pavements. So obviously they didn't have very much diversification at all, and they really only had one major client, being main roads, and then other smaller clients being, you know, various residential subdivision clients. So they've obviously got a higher risk as an engineering firm than, you know, a broad-based engineering firm that you know, advises on all sorts of different projects. Staff retention. So if the skills of the staff are particularly important, and you've got a history of high turnover, that's a risk factor. Your spread nature and loyalty.
Sorry, Peter, just on the example of that, there's an analysis out there that basically shows to actually change a staff member, the cost to the actual business is usually somewhere in the order of about 150% of what the salary is. And if you look at someone like an accountancy or law firm, to actually lose a senior manager in a business that actually is unexpected and not wanted, what's the effect on the business?
Because you know, in an accountancy practice where you've got a staff member, first year they learn the client, second year they, you know, they remember it, third year they normally get the job done under budget, and then it's if they then leave and you've got to start training someone up again, you go through it all again. Spread nature and loyalty of clients. So obviously if you've got a business that's got, you know, two really big clients that account for 90%. There's one I was looking at recently that basically had one client. It was basically a spray painting business, but spray painted mining equipment. 90% of its income came from one client. So if they lose that client, what happens to that business? Similarly, stability of customers and suppliers. If you've got one big customer, you're a lot riskier than someone who's got, you know, 50 equal clients but of a smaller individually. Systems and controls. So a business that has systems and controls is hopefully less risky than one that hasn't. And investment into the future. So you're looking there at, has this business been, you know, keeping up to date with its capex, with its capital expenditure and maintaining its equipment, or is it currently, you know, everything's on its last legs and they're going to have to go through some major pain in terms of pretty well utilising the next couple of years' profits in a you know, retooling or whatever. And thirdly, the working capital as the primary driver. I think we've explained before how it affects the level of goodwill, but not the business value. Working capital, that's something important to take into account. Your net tangible business assets, you probably need to take into account debtors, creditors, stock, and some sort of allowance for a cash balance. You know, assuming if you're valuing a business on, you know, earnings before interest and tax, you're pretty well assuming there is no overdraft and no borrowing. So you need to factor in that, you know, there needs to be a certain level of cash in the bank account at any one time, just as a safeguard. And prima facie, the greater the level of working capital, the lower the level of goodwill. So if you've got two businesses that both make $100,000 a year, both have an appropriate cap rate of 33%, but if one of them only needs, you know, no working capital because you fund all your stock through creditors, so essentially you've got an asset and a liability, a tangible asset and a tangible liability offsetting each other, that business will end up with a much higher level of goodwill than a business that has exactly the same scenario but pays for all its stock on delivery. So therefore there are no creditors and it has a high stock level. Sorry, what are you going to do?
Things getting a bit crazy here.
Sorry, just a bit of a problem there.
The last thing I want to quickly just touch on is when doing the physical valuations, how do you actually present the findings? The litigation side of things, most of our work we actually get a set of instructions, and we'll do our analysis, we'll come up and do the valuation, do the site visit, and then we'll present everything in a report that goes out to the solicitors. Solicitors filter through the clients, and that's our last bit of involvement for some time.
So that's something that John just mentioned, a site visit there. We didn't really mention in undertaking the valuation. That's something that's important. You can't just do a valuation by looking at the financial statements. Really, as a minimum, you've got to at least put questions to the owner, whether that's in writing or verbally, and preferably via a site visit. Sorry, John.
What we find, though, when we actually put the report out there is generally the clients and the lawyers, on the whole, have different levels of understanding of our report, and quite often just don't understand it. So what happens is they flick over to the summary page, look at the actual amount we come up with, and basically come positional on that amount. So one party to the transaction will say that's too high. The other one will say, oh, I would have thought it was more than that. I'm happy to adopt what's there. So from that point of view, our report isn't understood. Everyone becomes positional, and from that point on, disagreements start escalating. Now, if we're in a litigation matter already, that obviously is just adding fuel to the fire. But we also find very often with succession, so someone buying in, selling out of a practice or a business, we find that what actually happens is by doing a cold report without people actually physically understanding what we're doing, that essentially disagreement and conflict arises. So from that point of view, we've started doing things on a slightly different approach in that on a lot of our matters, we're doing essentially a non-report approach. That non-report approach is that we still do the same lead work into our matter. And once we're ready, we actually sit down, we actually hold a meeting with all of the parties. This works if it's a buy-sell, or it very much works if it's the litigation side, depending on the parties involved. We do basically an introductory valuation session, so everyone basically broadly understands what we're trying to achieve. We then do essentially our site interview, not our site visit. We quite often still do the site visit, but we do our site interview. The questions we'd normally ask, we ask in that room. And what that allows everyone to do is we'll do actually a sort of analysis of the trading performance. But doing the site questions in the room is that everyone actually hears the questions and the answers, so it's very transparent, and it also gets buy-in from everybody. You say something that someone doesn't agree with, they're going to mark up. So it actually promotes discussion and a level of confidence between the players.
So, for example, we might say, Bill, what do you think your commercial salary is? And Bill might say what he thinks it is, and Fred, or to employ someone to do that job, and Fred might say, no, I don't think it's 140,000. I think it's 150. So if they're that close, they might say, look, we'll just split it down the middle.
Mm-hmm.
But they each have a chance. It's a lot easier to do it, in a reasonably friendly environment where they need to put their own views forward and agree on each of those factors that go towards making up the valuation individually as items rather than being focused on a number at the end of the day.
The important thing with any valuation is that all the parties understand the process, but also understand the factors that are going into it. So if we can sit there and say, look, going forward, the sales are going to increase or decrease, if we're going to get agreement by everybody as to the end result, they need to agree on each of the individual amounts on the way through. So we actually break it down to a micro-level analysis. We talk about the sales, we talk about the margins, we talk about the expenses. And if you've done the pre-work correctly, what I find is you actually get a lot of agreement on the way through. And what we find is that the outcome, people are actually buying into the outcome and actually understanding the result. It's still our work. We still come up with the answer, but they understand it. And then if they've got any queries, we have the real-time answers to those queries on the spot, which in a litigation sense is, again, for the right matter, really quite a bit of assistance. The other thing is to make important there is the actual parties actually physically in the room. If we have a litigation matter, we more often than not have both the parties, both the solicitors, and the accountant for the actual physical clients. That accountant is going to know more about the business and its trading than quite often the actual owners. But also the parties themselves potentially have a high level of comfort when they've actually got someone in the room they've been dealing with for a number of years. Tremendous resource for us as well, actually asking what's physically happened. Now, if it's something like a matrimonial, we have mum and dad in the room, we have their solicitors, we have the accountant who's dealt more with the husband or the business owner. quite often the other side, usually the wife, will actually bring a comfort person in themselves they can actually physically talk to and actually gain comfort. What we're finding is this process for the right matter, and it's probably 30% of what we do is the right matter, if the cost is slightly less, but the outcome, people have actually bought into the outcome as opposed to just coming positional on a figure they don't understand.
And when we say the cost, I mean, we're not talking about the cost of our fee, but normally the thing's wound up a lot quickly. So it's not just a,
So there's probably less lawyers' costs or less advisors' costs going forward as well, because it just gets over and done quicker. But there's also the emotional cost, because you get it over and done with and put behind you and you can move on.
And what we're talking about here is just all those same points. So look, we've got, miraculously we've finished with 2 minutes to spare. Are there any questions? If there are any questions, by all means email those in now and we'll see if we can address them. But if not, we'll stay on the line for a little bit longer, but thank you for listening.
And if you do have any questions that do come up, our contact details are there, and please feel free to give us a quick 5-minute phone call if need be. If something comes across your desk, you just need to bounce something off us, or if yeah. Thank you very much.
Thank you.